Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM, and my email address is rshaw@fxcm.com. And of course, if you guys need to get hold of me, that's the best way to do it. Today is Thursday, and it is the 12th of May, 2022. I'm just going to bring up our high-risk investment warning. I want to keep this on screen for a few moments. Hey Zanetta, good morning to you, and thank you very much for joining. Thank you everyone for logging in, and of course the markets are absolutely interesting at the moment and quite brutal. Let's go ahead and bring up our market commentaries disclaimer. Our reference is MarketScope 2.0, CNBC, and we'll look at TradingView as well. Just before we get into the TradingView analysis, let's go through the CNBC note. Hey Rob, all right, so that's a good question. Hey Anna, good morning. Morning Rob, morning Indran. Rob's just asking, is there a good book to learn about chart patterns? The first thing that comes to mind, Rob, is actually the educational section on stockcharts.com, which is in of itself a brilliant resource. It's got, I think, everything you're looking for right there. So that's stockcharts.com. Just go through to the educational section and let me know what you think. If you know you don't think it's quite what you're after, let me know. But give that a go and let me know what you think. All right. Let's go through to the morning report on CNBC, and it reads as follows: European market set to plunge as US inflation runs hot. European stocks are expected to fall sharply at the open as global markets digest the latest inflation reading out of the United States. The reading has sparked concerns that a path of aggressive rate hiking lies ahead. Global investors are digesting the April inflation reading from the US, which shows the consumer price index surged 8.3% in April as compared with a year ago. The inflation rate was higher than expected and still running close to the 40-year high of 8.5%. Analysts are mixed as whether the data suggests inflation has hit a peak. We looked at this yesterday. My opinion, again, subject to correction, where I think the economics has changed is in terms of the PPI spike. I think that's really a major influence, and I'm not sure, you know, how that's factoring into economic analysis. But when we looked at it yesterday, and I think our approach was quite sensical, whilst we suggested we probably near the apex, to call a top now is premature. We may be at the top. We may be. I mean, 8.3 certainly is the first time that the inflation rate has fallen over 8 months. But the PPI number today, I think, is going to be important. We want to see a moderation in that. The April reading, which represented a slight ease from March's peak, was also above the Dow Jones estimate for an 8.1% gain. Shares on Wall Street dropped following the data, and markets in Asia Pacific declined Thursday morning trade following the losses stateside. Just something else, the reason also that I think the markets are getting sold off, I think that the Fed, to me, is losing credibility. I mean, I've spoken to various analysts. Some say no, they think the communications is good. Some say it's not good. I don't think it's good. I don't think you take 75 basis points off the table. You don't have to go with a 75 basis point hike, but to take that off the table when you've got this real rampant inflation running, well, it just seems like you're shooting yourself in the foot. And I think the market is worried about that, and hence part of the sell-off, I think, can be attributable to that. You saw the huge rally Wednesday, and then the utter capitulation since then. US stock futures were slightly higher on Wednesday evening as investors look ahead. The latest, let me just read this again. US stock futures were slightly higher Wednesday evening as investors look ahead. The latest US data on jobless claims and the producer price index, which measures price at the wholesale level. We're going to get earnings in Europe from Allianz, Commerzbank, Siemens, and Zurich Insurance. The UK preliminary GDP for the first quarter is also due. It's probably already out, actually. And I'll just bring that up. And I'll use Forex Factory for that, which I haven't indicated in my references. Let's just bring that across. And here you can see the prelim GDP here is a miss. It's very disappointing at 0.8%. The big deal about that is what the statement from the Bank of England had said last week: higher inflation, lower growth. Right. So yes, sort of perhaps the lower growth that we're starting to see. All right. They did suggest the inflation sort of double digits by year end, whereas the GDP slow down sooner than that. All right. All right. So what I'd like to do this morning, and again, I'm very open to being sort of led by you guys, but I want to just go through the sort of anatomy of a bear market. I think it's important. So let's just go ahead and bring up Paint. And what I'm referring to here is effectively the stages or the phases of a bull and a bear market as per Dow theory, as per a theory that was effectively proposed over 100 years ago. And Charles Dow suggested that a bull market moves up in 3 stages or 3 phases. So you'd get one. Then the second stage is usually the longest. Now the third stage, I don't think I've done this quite right. It should be more like that. The second stage is the longest and the most, I guess, the most sensical, because it's what we call improved earnings. The third stage is rampant speculation, and the idea is, of course, it's the idea you'll make the most gains, also the most dangerous part of the bull market to be participating. It's also where the novices get involved. The pros get involved stage 1, stage 2, novices stage 3, and that leads us through to the 3 stages of the bear market. And phase 1 here is like that. Then we get this, straight like that, and then we get this. Okay, so let's just put names to this. So the first one is called abandonment of hope. Let's make it plural, abandonment of hopes. Okay, that's where the sort of market starts realizing, like, well, wait a second, PEs are too high, dividend yields too low. And then what happens is once the market realizes that the price for the earnings is too high, well, that brings us into the next phase. The next phase is a decrease in earnings. Okay, very much part of the just a function of the business cycle. And then this phase is what we call distress selling, panic selling. Okay, which is just the really the most vicious part of the bear market, which is an absolute bloodbath out there. I'm not sure we're in the distress selling yet, but I mean, one would be forgiven for making the case that we are in it. Just want to go through a few of the characteristics of phase 2 and phase 3. Phase 2, which is the decrease in earnings, is generally the longest, probably the most orderly of the 3 bear market phases. And it takes some real willpower to hold on to positions in anticipation that it's just a phase. Really, it can give one a real heartburn as you see the capitulation. And I think the FANG earnings for Q1 pretty much seem to suggest phase 2, right? Some of the previous leaders, crash and burn. Well, there's the FANGs, right? But either go into liquidation, well, we're perhaps not going into liquidation, or they're taking over at negligible prices. Well, which big company is being taken over by the richest man in the world, right? Shareholders suffer enormous losses. Previous darlings fallen anywhere between 60 and 80%. Still held by the general public and professionals, but primarily by the public, in the vain hope that there's a mispricing here and that they're going to recover. Bankruptcies become a real risk throughout the economy. General public starts to lose interest in the share market and even turn a blind eye. Fundamentals start returning to reasonable values. Okay. That puts us into the distressed selling. Okay, the next part is the distressed selling phase. This is basically the finale for the bear market. Okay. There are increasing reports of companies that are in severe difficulties or that they are potentially going to fail. Okay. There are funds that now start looking for distressed companies for assets and look to take them in terms of some sort of private equity deal. Bankruptcies, failures are high profile. Rob wrote about Terra, sent me the message about Terra. I wrote an article on Terra Luna. I mean, it's not a crypto that I follow in any sense. Yesterday just made for interesting, but the capitulation there is absolutely ridiculous. Absolutely ridiculous. Let's just bring up the Luna chart. What a sideshow, really. Okay, so let's just take a look at this. Look at this on the daily. I mean, we're at 22 cents from a high of $120 from a month ago. Jeez, it's just, you know, exuberance at extreme. The distressed selling would see now fundamentals like PEs and dividend yields showing some sort of undervalue. Professionals begin patiently accumulating because the companies have been sold off by disillusioned market participants that have now become financially strapped. But even though the professionals are accumulating, the supply still is the greater force. So prices don't get a bid. Instead, the professionals are simply absorbing shares that are offered by the public. Those that speculated near or top of the market are now desperate to sell. The desperation is driving huge fear that prices are never ever going to recover. There's just a huge pessimism out there. The thinking is, let's get out while we have something left. The selling could be driven by meeting debt payments, often associated with rising unemployment, which we're not quite there yet. brokers start cutting down on staff. They start focusing almost on institutionals and professional clients because the retail pool has all but dried up. People that have been day trading for a living, never heard of again. All the gurus from the previous leg up just disappear into the nether. Promoters that are selling super products just close doors and disappear. And of course, the magazines, the news stories are just talking about a absolute market capitulation. So that's some of the characteristics. And let's just go back to the Dow Jones here. Let me just take a look. There's a few comments that have come up here. Zanetta writing, pound has hit the lowest level on the month chart. US dollar is the highest. Is there going to be a bounce back? Anna's talking about death spirals this morning. And Katie, can you please go through NASDAQ and oil using Heiken-Ashi? And Anna's asking, can we look at the VIX? Yes, all of those are very good points. All right. I'm going to keep those just on the sort of back burner for now. Let's just go through the Dow Jones using the COPOC. Now, if we're using the COPOC, we must use the monthly chart, otherwise we're going to get a misreading. Okay, so the COPOC is something that I'd like to keep an eye on as the markets unfold. I don't know if they're going to turn up before it hits the zero, but certainly if we hit the zero and drop below, I would suggest that there's probably a lot of value out there. It's probably time to go shopping. Of course, one would need to be discerning, right, and have a very clear investment plan with all the risk protocols. But the idea here is we're not quite in that value territory yet. We're not quite, so that the sell-off here may certainly continue. So just wanted to show the COPOC here is not quite where we need it. So we'll carry on watching that. When we get to that COPOC, well, that's probably sort of the end of the distressed selling, or maybe in the midst of the distressed selling, but on the border of the first phase of the bull market. What's the first phase of the bull market? It's what we call renewed confidence. Okay, so whilst the market here is bleeding, okay, you know, we can just take a back seat. We can, you know, as I like to say, go fishing. But we are always looking for opportunities, because the bear market will end. However, I'm not certain we've reached that capitulation yet, that real panic selling. I think we're kind of in phase 2, but we'll keep an eye on this. Am I looking about good companies or buying the index? And I would be looking for good companies to add to a portfolio in the renewed confidence phase, or even the end of the panic selling stage, you know. But of course, the index, an index like the S&P is by definition would represent strong companies, because it's a momentum index, the way that it is constructed. All right, let's just go through to this chart here, which is again US30 weekly. This is a dangerous looking chart, and the reason I say it's dangerous, look at the stochastic here. Okay, this is my momentum indicator of choice, and it's heading towards that 20. Now, what I am really concerned about, of course, is that it hits 20 and holds, and that's going to be disastrous for market prices. Okay, if we hit this 20 and it holds, that just means there is a bearish pressure that's being applied to this, and that's something that so you know, looking for bargains right now is fraught with danger. It's fraught with danger, and again, I'm not sure we're at that value stage just yet. Not to say that there can't be some sort of pickup, because nobody knows what's going to happen in the market, but just looking at it in terms of COPOC, are we in value? Not quite yet. Momentum, okay, stochastic, heading to that lower quintile, okay, it's really looking very dangerous. Yeah, this is stochastic, Katie, let me show you. So I'm just looking at the percent K. So I've taken out the percent D. I don't need the percent D here, so I've taken it out because it's. I just want to see where the actual percent K is. All right. Now we want to keep an eye on this momentum. Okay. If it hits 20 and curls and starts moving up, that's good news. That's good news, right? Take a look at the trend. Let's take a look at the trend here. Reference peak, let's put in our reference trough right there. Okay, here's our reference, sorry, here's our lower peak. Here's the lower trough. As soon as we took out that trough, that's actually where the downtrend began. That was the big bear market. Here's the next lower peak. Here's the next lower trough. And what we did spot, what I think was quite useful, was the bear market rally. But this capitulation here was much more vicious than I thought, because I was thinking, well, is there going to be some sort of higher trough here before we get the capitulation? No, the capitulation happened without that higher trough. Let's just take a look at DAX. Okay, so the DAX not quite as bearish as the US30. That higher trough here is, I'll leave it there with a question mark, but of course the stochastic here, Katie, rolling over. Okay, question is, does it hit this lower quintile? So the bearish pressures are certainly there. Okay, what we need to do is just recognize that any sort of rally from this point can still be a bear market rally. We've got to be quite careful here, because fundamentally we're in a very hard, challenging environment. Yields rising, real yields have now turned positive. In other words, they're beating the inflation. The stagflationary potential is still very much a part of the conversation. Supply chains still squeezed. A lot of the influence coming from geopolitics, as well as the lockdown in China, and I don't see that happening until I don't see that perhaps correcting. And this is the scary part, until we see that adjustment in the unemployment rate, which we looked at yesterday. I hope we don't go that way, but of course, classical economic theory suggests that in a stagflationary environment, although policymakers may try and influence, it's generally the labor market where the adjustments take place. So let's just be aware of that, and we'll just see if that is what takes place. And the big question here, going through to Zanetta's question, what about the US dollar? And I think I was having a chat with a friend this morning, and we're just talking about, we're actually talking about our local currency here. It's not one that I follow. And I just said, I think that the US dollar is the story. I think that the US dollar is hitting all instruments. It's hitting instruments from the rand. It's hitting the euro. It's hitting the pound. It's hitting Bitcoin. It's hitting gold. It's making companies that are export heavy less profitable. This is just a major factor in the intermarket relationships. And the question is, of course, well, how much higher is this going to go? And that's $1 million question, right? I don't know. The fact of the matter is we saw a big inflation number yesterday. We want to watch PPI again, and tomorrow we're going to have to, the same analysis we did yesterday, I think it's worth doing again tomorrow, because we're going to have the updated PPI numbers. And the key there is, I think there's still a lot of adjustments to take place. So the dollar seems to be supported until proven otherwise. Well, if the dollar is still supported, any sort of pullbacks here, are probably dips that we want to be keeping an eye on. They're probably dips we want to be keeping an eye on. So Zanetta asks a brilliant question. Should there be some sort of bounces in the pound pullbacks in the US dollar? And conventional sort of thinking would suggest yes. Of course, the markets don't move in a straight line, but those bounces would probably be opportunities for buying the dip in the uptrend. There'd probably be opportunities for selling the rallies or shorting the rallies in a downtrend. And we don't want to get caught by any bear market sort of rallies. Just be very aware of that, Zanetta, because it's not the bear markets that hurt, it's the bear market rallies that hurt. So to answer your question is, it's certainly a strong probability. So if I had put in the RSI here, and we've seen it before, it is overbought. Okay. The problem is on a weekly chart, it's very difficult to use the RSI in terms of timing. We can go down to the daily chart, but I'm not sure that the daily chart here is suggesting anything that other than more dollar strength. We're not quite in that over 80 area. So let's see how the PPR comes out. Let's see what happens with the PPR, because that's going to have, I think, a big effect on policy. I really am of that opinion. I think we can't neglect that, and I think a lot of analysis is neglecting that part. It's not a full inflationary picture, because we haven't had a stagflationary environment since the early 80s, late 70s. So I don't think people are adding those variables or analyzing those variables. A lot of people, I don't think, are ignoring those variables in their analysis. So what about the other half of the question, which was pound US dollar? So pound US dollar here, in my opinion, is actually getting it's getting hit. It's getting hit on both sides of the numerator and the denominator. It's getting hit on the pound side, which is the numerator, and it's getting hit from the dollar side, which is the denominator. Clearly, the denominator is the easy one to explain, right? Because we've seen the trend in the US dollar moving up. Clearly, that's going to be a headwind for the numerator if the denominator is moving up. It's going to be, it's just absolute mathematical sense. Where's the pressure from the pound side? The pressure is from the Bank of England, actually. So if we go through to a daily chart here, this is the sell down last week. It's a huge sell down after the Bank of England released its statements. Now this is actually a puzzling movement. Okay, this is a very puzzling movement. You've got to think of this very carefully. And the reason that it's a puzzling movement is because there's 9 voting members on the policy committee, right? And there was a 25 basis point hike last week. Of the 9 members, 3 actually were looking for a 50 basis point hike. So on first glance, it looks as if it's a fairly hawkish policy committee, right? Because 3 are looking for higher rates, and 6 are looking for 25. And then you get a massive sell-off, and you've got to ask, well, that makes you've got to make a statement that makes no sense if the 3 members were hawkish. But that is not how the market's interpreted, and I think the market interpretation is quite correct. if you read the statement for the from the Bank of England, they say there's going to be higher inflation up to double digits towards the end of the year, and we're going to see lower growth. That lower growth, I think, has got the policymakers really concerned. But then what do you do if you think that there's going to be higher inflation as well? Well, one tactic may be to front load the interest rate so that the hike is done now, and that you don't have to hike in the future, so that you've done the hard, you've now got the hard stuff behind you. So the 50 basis points, the 350 basis points, actually dovish. It's kind of, we have to do 50 now because we're going to be in such trouble in the future. We won't be able to raise in the future. But the market didn't like it one bit, and we've got the pound really selling off to the point that it is oversold. So to answer your question, Zanetta, I think a bounce is certainly a viable option. However, is it something that I would be looking to trade? Not on your life. Personally, not. I'd be looking to short into it. But of course, there have to be the right setups. I'd have to use stop losses. I'd have to use risk management, and the triggers and the signals have to be pulled. So it's something that is certainly a good question. Now, Anna's talking about this death spiral, and I think that is really interesting. You see, in the phase, the third phase of the bull markets, you're going to have a media that is completely contributing to the euphoria. In the end phases of a bear market, you're going to have a media that is completely contributing to the panic. So the fact that they're talking about a death spiral, one may think, well, is this a contrarian type of signal? Now, I don't want to be a contrarian right now, but I would suggest we should start and be looking for bad news that is not driving the market further down, because that's actually a bullish sign, right? So the closer we get to the bottom, the harsher the media becomes with their news. And that's actually, it's an indicator. It's a contrarian indicator, right? So we want to look at that. It's almost a sentiment-based indicator. Again, not in isolation. Cannot be used in isolation. The problem with using it in isolation is we're not factoring that the COPOC is not in value territory. We're not factoring that the stochastic is moving into a very negative area. So all of these things are part of the toolbox. But the fact that they're talking about the death spiral, I think, is, of course, part and parcel of the evolution of the bear market. We want to see if they get even more bearish with those comments, Anna, and then see if there is some sort of way we can come in as a contrarian. I would suggest it's too early now. Please, I'm not suggesting that it's you blindly go out and buy now. That would be silly. But it's very interesting that you brought that up. Very interesting indeed. All right, let's just see. There's a lot of comments coming in here. This is the headline. So this is from Anna. This is the headline. At least there's a bull market in death spirals. That is one hell of a headline. All right. Let's go through to. There's lots of comments. I'm going to get to all of them. All right. I'm moving now to Katie's asking if we can look at NASDAQ and oil using Hike and Ashley. Yes, I certainly can do that. So let's just go through to NASDAQ. Let's do the NASDAQ first in terms of a just a peak and trough analysis, Katie. So let's bring that up. All right, so you can just see it's been hurt. It's been really wounded here. We've got that lower peak, we've got the lower trough. Take a look at the stochastic here. We're in the lower quintile. That is bad news. Now, this makes perfect sense because we've been talking about this for months now. in that it's the growth part of the index that's going to really take the full force of the higher rates. That's what we're seeing right here. So you can see this is just getting absolutely savaged at the moment. And again, yesterday's CPI number certainly didn't do the Nasdaq any favors, and I don't believe the PPI is something that we should be counting on. Let's see how the print is, but we need to really see that PPI come down. I think once we see the moderation there, Katie, then perhaps the stochastic pops out of the 20. Perhaps we get the COPOC showing us more value. Let's just take a look at COPOC on the Nasdaq. See, perhaps there is some value that's starting to creep in here. All right, not quite there yet. We must put in the 0. Yeah, we're getting pretty close. Yeah, we're getting pretty close. Okay, so here's the 0. Let's just keep an eye on that. But certainly, I think the likelihood of further pain is certainly there, and that means that if there's any sort of bounces here, Katie, I'd be very suspicious of them. I'd be very suspicious of them. If we want to add what time frame do you want to look at in terms of the Heikin Ashi? I'm just going to put it on the weeklies, but I'm quite convinced we're going to get a red Heikin Ashis here. So I'll just go through to the okay, you can just see that there is a monster leg down in terms of Heikin Ashi here. Katie's just asking for daily, certainly. So the way we'll do that is let's go to the daily here. All right, so it's red in zone 3. The stochastic, you can see this is what a very stochastic looks like. See how it just holds at 20. There's the momentum. It's worth pointing out here, Katie, that we are getting a overbought condition. So I beg your pardon, an oversold condition. Any sort of normalization there, I would be suspicious of. I'd be suspicious of. So, hey Zanetta, no worries, we'll chat soon. So let's just be cognizant of the primary trends. Let's just go to the next chart, which Katie asked for, which was oil. Okay. Let's do the same sort of analysis. All right. I want to take the Heikin Ashi out for now. This is now just normal candlesticks, and there is certainly a battle going on right at this upper boundary for oil. So Katie, let's take this out for the moment, and just let's take a look at it in terms of the last few weeks. And you'll see that we're actually moving sideways over here, and the momentum on the stochastic here is, of course, neutral, and the RSI is near 50. So the weekly momentum here still seems very much part of a consolidation in nature. Let's just carry on watching this. I don't think the Heikin Ashi here is going to be useful. Maybe on the daily. Let's just take a look here. I'm going to re-put it in. Put it in again. Heikin Ashi. So we're in zone 2, which is neutral on oil. Okay, the Heikin Ashi is blue, but it's in neutral. So we just want to see if it pops above into zone 1, and we very much, even on the dailies, we've got neutral momentum on both the RSI and the stochastic. So almost the calm before the, it's almost before the calm before the storm. Is oil not driven much more by fundamentals these days? Absolutely, absolutely. So what are the fundamentals there? We've got a excess demand, right? We've got an excess demand. So and the greater the supply exacerbates, the more support we get for oil. But at the moment, it's just treading water. I think that the you know, there's still a lot to be said from the geopolitics, a lot to come out of that. All right, let's just see what else we've got here. Begging your pardon, I'm just going down the list. Anna asking if we can look at the VIX. Yeah, that's a good idea. All right, so okay, so what the VIX, let's get a bit longer. Okay, so the way that the VIX works, what is the VIX? Well, the VIX is effectively a volatility index that is compiled using options on companies within the S&P 500. And the way that it tends to work is when there is low volatility, in other words, everybody is thinking everything's fine, price is going to move higher. If you use that as a contrarian indicator, it's probably a time to be cautious. When the VIX starts increasing, that means the put options are starting to be favored over the call options. That would suggest that, of course, when we start reaching extremes on the VIX, it's probably a good time to be looking to go contrarian. And I think that the fact that we've got a fairly high reading here, I mean, the market's just broken, right, for 2022. So we're kind of at this high level here. We may get some sort of bounce. If we get some sort of bounce, I don't think it's too surprising if we go through to the daily. Let's just go through to the S&P 500 here. Let's see what it looks like in terms of being oversold. Yeah, we're getting pretty close to this oversold position here. So I think as this moves into an oversold position, given where the VIX is, some sort of bounce would certainly be sensical, but I would treat it with suspicion until proven otherwise. Let me know if that helps, Anna. I'm just working down the list. Markets believe the BOE as okay. So Gurdeep, I believe you're asking about the communication of the BOE or the Fed. So I was discussing this with my colleague Nick. He's much more impressed by the communication coming out of the Fed, and he thinks that the Bank of England is more muddied in its communication. And I think to a large degree that's correct. The BOE really battled to find its feet towards the end of last year, but the Fed, to me, has lost a lot of credibility. Personally, in my opinion, it's lost a lot of credibility. So I don't think either of those banks are communicating particularly well at the moment. What's going to happen with the Bank of England in terms of hikes going forward? It's a bit muddy, as Nick says. We don't quite know that. That attempt to front load the hikes, Gurdeep, I think that panicked the market. You can see exactly how the pound fell through the floor there. Both banks could do a better job in communicating, and I think the Fed taking that 75 basis points off the table, schoolboy error. So not enamored by either. at the moment. Let me know if that is if that answers your question. Rob asking, do I have any thoughts on Twitter and Activision? My thoughts were it highlights the market uncertainty. I think I might have to think about this one for a while. So clearly, it has introduced uncertainty that one cannot argue against. If you looking to trading Twitter, there's a huge uncertainty environment, a huge uncertainty around it. Is it going to become private? Is it going to still remain public? And it all depends on how successful the bid is, right? What's happening with the bid is with the markets in the market being in flux. I think, Rob, I think this is the big deal. The market being in flux is really disrupting the bid proposal, because a large part of it has been financed by stock, right? So there's certainly an element of uncertainty. I think that your comment is quite correct. What I find interesting is just the fact that it's happening at a time in the market when clearly we are in this bear market. So it seems to be a common characteristic that repeats during these bear market phases. I'm not sure if I've answered the question, Rob. I may have to give it more thought. I think the simple answer to that is that it does, I would agree, it highlights market uncertainty. Let's just see if there's anything else. Anna says, wouldn't I expect the VIX to be higher? So let me, again, a good question, Anna. I'm going to suggest that the fact that it's not higher is problematic. I'm going to suggest that it's not higher is problematic. Why would it be problematic? It's because the panic selling then doesn't seem to have started. You see, with the VIX, you want it to reach extremes. Once it reaches that extreme, then you want to take the contrarian. We're kind of in a respectable area here. I don't think that, let's add an RSI. I don't think that we are overbought by any means. And the fact that we are not overbought suggests that there's a lot more activity to be had on the put side to push us into a panic selling stage. That's a distinct possibility. Let's just add the RSI here. Okay, so we're not in any sort of extreme here. It's really the extremes that we want to adopt contrarian stances. The fact that we're sort of sitting here in sort of normal territory, well, that's a worry. Does that mean that we're in phase 2 and that the puts now are kind of happy with the way they've protected their portfolios? What happens if the panic selling now ensues and we get a spike up? But then it becomes very interesting, because that in itself then becomes a sentiment indicator worth considering very, very carefully. Does that answer the question then? And I think I've answered what you were asking, but just, okay, brilliant. Gertie's asking, not independent of politics enough. He's referring to Fed and the Bank of England. Gertie, I would like to think that they are independent of politics. But I'm going to obviously stick the phrase "subject to correction" onto that sentence, because who knows what's going on behind the scenes. The Fed, especially during the Trump years, did a good job in maintaining a fair amount of independence. I think that was obvious. Where I think that it lost its credibility is not so much in bending to politics, but in incorrect analysis of inflation, holding on to that transitory for the whole of 2021 until finally retiring it at the end of November. That's put a lot of strain. It's put a lot of strain on the financial system, and that coupled with expansive fiscal policy. You know, a lot of the sort of the checks that were received in the money, a lot of the checks received in the mail has contributed to demand side inflation to a huge degree. Whether it was right or wrong, I think comes down to a matter of your own political philosophy. What I think can't be debated is, of course, the fact that because of that there has been huge inflation. What can be debated is, well, what would have happened if the CARES Act wasn't passed? Would that have led to even more damage in the economy? And that's a fair debate. But the fact of the matter is, the expansionary fiscal policy with the incorrect characterization of inflation has now just put us into a terrible demand side inflation environment. And then we were hit with almost a perfect storm of supply shocks. The geopolitics, lockdown in China, has just absolutely contributed to an environment which is extremely dangerous economically. Why is it dangerous economically? Because now we're looking not at inflation, now we're looking at stagflation. And stagflation is an anomaly, and it's an economic paradox. And policymakers don't have a policy that can adequately deal with stagflation. You've got to choose the greatest evil here. Is the greatest evil your inflation, or is the greatest evil economic growth dangers? And then you've got to treat which one you think is the greater danger by hurting the other one. So policies are very much come down to a damned if you do, damned if you don't in stagflation. And that's because it's an economic paradox. And I think, Gertie, given that we're now sort of facing this economic paradox, remember, it's an anomaly, it's not the norm. It's, as a policymaker, be it policymakers on the Fed or be it policymakers on the Bank of England, are really, they've got a terribly difficult job in front of them. And because whichever choice they make is going to affect the economy, perhaps politics is starting to creep in. Let me know if that answers your question, Gertie. All right. Any other questions there, guys? Any other questions? I think what we'll do is we will conclude at this point. Tomorrow, we'll look at the macroeconomics again, because I think it's really influencing market at the moment. But this time we'll have a little extra information because PPI is coming out today, 230 ZA, 130 UK. Okay, no worries, Gertie. Guys, have a great day. We'll chat tomorrow. If you guys need to get hold of me, just send me an email.